An IPO, or initial public offering, is a process when a privately held company begins selling stock to outside investors and therefore becoming a public company. From that point on, the company can raise the capital it needs by selling shares. At this stage, it must also comply with a strict set of reporting guidelines established by the Securities and Exchange Commission, the SEC. What initially happens is that the company hires an investment bank to come in and underwrite the IPO. The bank will then put up a sum of money to fund the IPO and agree to buy the shares being offered before they're actually listed on a public exchange. The bank benefits in the form of paying less per share than what they end up selling for publicly. The primary benefit of going public is gaining access to large amounts of capital. That money can then be used for things such as expansion, research and development, or marketing. Although IPOs can be good for the companies behind them, they're not always great for investors. Investing in IPOs can be profitable, but generally they're a much riskier prospect than investing in established companies with a strong history of solid performance. Although there are exceptions, IPO stocks tend to underperform for several years after being issued compared to the general market. This is because the companies behind them are usually more focused on growing the business rather than delivering profits to investors. Those investing in IPOs should therefore take caution and vet the companies carefully before moving forward.